There is a language spoken by the financial elite, a dialect of capital that sounds like utter nonsense to the uninitiated. It's a language where bad news is good news, where widespread panic is a cause for quiet celebration, and where a sea of red ink on a screen is seen not as a warning of impending doom, but as the opening bell for the greatest sale on earth. This language has one core principle, a single foundational truth from which all intelligent investing flows. It is the master key that unlocks the vaults of Wall Street and turns the market's most terrifying moments into generational buying opportunities. This principle is not a complex algorithm, nor is it a secret handed down in smoke-filled rooms. It is a simple, profound concept known as the margin of safety. For decades, Warren Buffett, the most successful investor in human history, has used this single idea to transform market crashes from portfolio-destroying catastrophes into the very bedrock of his fortune. He has taught us that the goal is not to predict the rain but to build the ark. Today, you are not just going to learn the blueprints for that ark. You are going to be handed the tools to build it. You will learn to stop seeing market volatility as a threat and start wielding it as your primary weapon for wealth creation. You will learn how to use the market's fear to buy $1 worth of a great American business for 50 cents, for 40 cents, or even less. This is not about timing the market. It is about valuing the market. This is the definitive guide to never wasting a good crisis again. We begin with the most fundamental schism in all of finance, a crack in the pavement of Wall Street that widens into a chasm, on one side of which stand the 99% who consistently lose or underperform, and on the other, the 1% who build dynasties. This is the profound and often misunderstood distinction between price and value. Price is what you pay. Value is what you get. This phrase is so simple, so folksy, that most people dismiss it as a platitude. But inside that simple sentence lies the entire secret to investment success. Price is the ticker symbol flashing on a screen, a fleeting consensus of opinion driven by greed, fear, and algorithm. Value is the bedrock reality of the business itself, its factories, its brand, its cash flow, its position in the world. Price is mercurial, emotional, and often insane. Value is sober, patient, and rooted in economic reality. The amateur investor, the speculator, the gambler, they are all slaves to price. The professional, the true investor, is a master of value. And there is no greater story to illustrate this divide than Warren Buffett's daring purchase of a legendary American institution during one of the darkest periods in modern market history. The year was 1973. The air was thick with gloom. The Nifty 50, a group of one-decision blue-chip stocks that were supposed to be held forever, had utterly collapsed. The market was in the midst of a brutal, soul-crushing bear market that would ultimately shear stock values in half. It was a time of oil shocks, political scandal, and a pervasive sense that the American dream was running on fumes. In this environment of deep pessimism, the stock of the Washington Post Company was treated like a pariah. The company was an icon, a journalistic titan that had just broken the Watergate scandal, leading to the downfall of a president. It was a brand synonymous with integrity and power. It was also a profitable business, generating healthy cash flows. But the market, in its infinite and immediate wisdom, did not care. The price of its stock had been eviscerated. The entire company, with its legendary newspaper, its television stations, and its other media properties, was being valued by Wall Street at a mere $80 million. To the average investor, this collapsing price was a terrifying signal, a red flag screaming, "Get out! The ship is sinking." They saw the price and assumed the value was deteriorating along with it. But Warren Buffett, operating from his quiet office in Omaha, Nebraska, saw something entirely different. He did not see the flashing red quotes. He saw the business. He asked himself a question that the 99% never think to ask. If I had the money, would I buy the entire Washington Post Company for $80 million? He didn't need a supercomputer. He did a simple, back-of-the-envelope calculation. He looked at the television stations alone, just one part of the company, and conservatively valued them at around $400 million. That's 5 times the price the stock market was asking for the asterisks entire Tybee company. In the market's view, if you bought the entire enterprise for $80 million, you were getting the Pulitzer Prize-winning newspaper, Newsweek magazine, and other assets for less than free. You were being paid to take them. The market was offering a dollar bill, in this case, $5 of tangible business value for 50 cents, or in this case, closer to 20 cents. The disconnect between the price and the value was not just a gap, it was a cosmic abyss. He began buying aggressively. He flew to Washington to meet the company's matriarch, Katharine Graham. She was, understandably, wary. Wall Street was a foreign country, and here was this strange man from Omaha, this financial operator, buying up huge chunks of her family's legacy during its moment of weakness. She saw a predator. Buffett, however, saw a partner. He explained his philosophy not as a stock picker, but as a businessman who wanted to own a piece of a wonderful enterprise that he understood and admired. He wasn't there to strip it for parts or force a sale. He was there because the market was offering him a gift, an opportunity to buy into one of the country's finest businesses at a price that made no rational sense. Over the course of the next year, he invested nearly $11 million, accumulating a massive stake. The market continued to languish. His stake on paper went down. But he was not perturbed. He wasn't buying a stock. He was buying a business. He knew the value he had acquired. The price was just the temporary, irrational opinion of a panicked crowd. And sure enough, over the next decade and beyond, as the market's mood inevitably recovered and the Post's earnings continued to grow, the value was recognized. That $11 million investment would eventually become worth over $1 billion, a return of roughly 100 to 1. It became one of the cornerstone investments of his legend, a testament to the staggering power of focusing on what a business is worth while the rest of the world is screaming about what its stock is priced at. This story reveals the deep psychological currents that Buffett so masterfully navigates. The average person in 1973 was a victim of two powerful cognitive biases: anchoring and herd mentality. Anchoring bias is our brain's tendency to latch onto the first piece of information we receive, in this case, the stock's previous high price. When a stock falls from $50 to $25, our brain doesn't see a potentially cheaper asset. It sees a 50% loss. We are anchored to that $50 price, and every tick down feels like another failure, another reason to sell before it goes to zero. We become blind to the underlying reality that the business itself might still be worth $60 a share, making the $25 price a spectacular bargain. The price action itself becomes the entire story, and we are psychologically incapable of divorcing the stock's recent performance from the company's long-term value. This is compounded by the deafening roar of the herd. Herd mentality, or social proof, is a survival instinct baked into our DNA. For millennia, if you saw the rest of your tribe running, you didn't stop to analyze the situation. You ran too. Assuming the herd is right saved your ancestors from saber-toothed tigers. In the stock market, however, it gets you slaughtered. When the market crashes, the headlines are terrifying. The financial news pundits are grim-faced, and your neighbor is telling you he sold everything. Every social signal confirms your rising panic. The instinct to sell, to join the fleeing herd, is overwhelming. It feels like the safest thing to do. Yet, in investing, what is comfortable is rarely profitable. Buffett's genius is not in his mathematical ability, which he admits is unremarkable. It is in his temperament. He has an almost superhuman ability to disconnect from the emotional state of the crowd. While the herd was thundering over the cliff in 1974, he was calmly walking into the fields they had abandoned, picking up the gold they had dropped in their haste. He overrides the anchoring bias by ignoring past prices and calculating intrinsic value from scratch. He defeats the herd mentality by remembering that the market's primary purpose is to serve you, not to instruct you. So how do we, as aspiring intelligent investors, translate this into a practical, applicable mental model? The blueprint is something I call the business owner's test. and it is a powerful tool for reframing every investment decision you make. It is a three-step process. Step 1, before you even consider buying a single share of any company, is to ignore the stock price completely. Erase it from your mind. Instead, find the company's total market capitalization. This is the total price for the whole enterprise. You can find this on any financial website. Step 2 is to ask yourself the defining question. If I had access to unlimited capital, would I, right now, write a check for this entire amount to buy this entire company, lock, stock, and barrel? This question is a psychological atom bomb. It vaporizes the speculator's mindset and forces you into the shoes of a sober business person. You are no longer buying a ticker symbol, a lottery ticket you hope goes up. You are considering acquiring a real-world enterprise with employees, factories, brands, and customers. Step 3 is the analysis this question provokes. To answer it, you can't just look at a chart. You have to look at the business. Does it make consistent profits? Does it have a lot of debt? Do people love its products? Do you understand how it makes money? Could you explain it to a 10-year-old? Would you be comfortable owning this business if the stock market were to close for the next 10 years? This simple three-step process forces you to make the Buffett-like leap from price to value. If you look at a hot tech company with no profits and a $50 billion market cap and ask, would I buy this whole thing for $50 billion? The answer is likely a swift and certain no. But if you look at a stable, boring consumer goods company that earns $2 billion a year, has a beloved brand, and the market is valuing the whole thing at $20 billion during a market crash, the answer might be a resounding yes. The business owner's test is your shield against the madness of crowds. It is the filter that separates fleeting speculation from true investment, making it a cornerstone of any sound wealth management strategy. To truly appreciate the power of this model, we must spend some time examining its antithesis, the path of the 99%, the road that leads to financial ruin. This is the path of the speculator, who lives and dies by the squiggly line on the screen. The speculator does not know the difference between price and value. In fact, for them, price is value. A rising stock price is proof of a good company, and a falling stock price is proof of a bad one. Their entire analytical framework is based on momentum and narrative. The most catastrophic example of this mindset in our lifetime was the dot-com bubble of the late 1990s. An entire generation of investors became convinced that the old rules of business valuation no longer applied. It was a new paradigm. Companies with no profits, no revenues, and sometimes no finished products were being given market capitalizations in the tens of billions of dollars. Why? Because the price kept going up. The narrative was intoxicating. The internet was changing the world, and these companies were the gatekeepers of that new world. People bought Pets.com not because they analyzed its business model and concluded it was a durable, profitable enterprise, but because their neighbor got rich on it last week. They bought Webvan not because they calculated its potential cash flows, but because a television analyst said it was the future of grocery shopping. They were caught in a feedback loop of pure speculation. Rising prices attracted more buyers, which pushed prices even higher, which was taken as validation of the original absurd premise. They weren't performing a business owner's test. They were playing a game of musical chairs with dynamite. When the music stopped in March of 2000, the result was a financial apocalypse. Trillions of dollars in paper wealth vanished. Companies that were once hailed as titans of a new economy were revealed to be hollow shells, and they went bankrupt. The speculators who had conflated price with value were wiped out. They had paid $1 or $10 or $100 for 50 cents of actual, tangible business value, and in many cases for 0 cents of value. They had no margin of safety. When the tide of euphoria went out, they were left naked. This is the speculator's fate. They build their houses on the sand of price, and when the storm of reality inevitably comes, they are washed away. The direct financial connection of this value versus price discipline to your own bottom line is both profound and twofold. First, it is the ultimate defense. When you buy a business with a wide margin of safety, when you pay 50 cents for a dollar of demonstrable value, you build a massive buffer against the uncertainties of the future. Your valuation could be wrong. You could have misjudged the company's earnings power by 10 or even 20%. A new competitor could emerge. A recession could hit. But because you bought with such a large discount, these unforeseen problems are absorbed by the margin of safety. The buffer protects your principal. This is the very heart of Buffett's famous first two rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. A margin of safety is the only way to operationalize those rules. It is the difference between a temporary decline in a stock's price and a permanent loss of your capital. Second, it is the most powerful offense. The returns in investing are not made from buying fair businesses at fair prices. Extraordinary returns, the kind that lead to true financial freedom, are generated by the closing of that gap between the discounted price you paid and the full intrinsic value of the business. When you buy that dollar for 50 cents, your first 100% return comes simply from the market recognizing reality and repricing the asset to its fair value. Any growth in the business's value from that point on is pure gravy. This disciplined approach systematically removes the biggest risks from your portfolio while simultaneously setting you up for the greatest possible capital gains. It turns the entire process of stock picking from a frantic gamble into a calm, rational, and immensely profitable business endeavor. Of course, the entire concept of a margin of safety hinges on one critical ability. You must be able to determine, with a reasonable degree of confidence, what that dollar of value is actually worth. Without a firm grasp of a company's intrinsic value, the idea of buying it at a discount is meaningless. This brings us to our second pillar, the art of calculating what a business is truly worth. Most people believe this is a dark art, a realm of complex spreadsheets and arcane financial models, accessible only to Wall Street wizards. But the Buffett approach is, once again, shockingly simple and rooted in common sense. It is less about complex mathematics and more about a conservative business philosophy. And the story that best exemplifies this is not one of a celebrated blue-chip stock, but of a company mired in one of the most bizarre and public scandals of the 1960s. It's the story of the Great Salad Oil Scandal, and how it gave Buffett the opportunity to make one of the most stunningly profitable investments of his early career. In 1963, American Express was a Wall Street darling. It was a blue blood institution, the gold standard in travelers' checks and charge cards. But disaster struck. A small subsidiary of the company, a warehousing division, made a catastrophic error. They had extended huge loans to a company called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino DeAngelis. The loans were secured by the company's inventory of salad oil, which was supposedly stored in massive tanks in Bayonne, New Jersey. The problem was, the salad oil didn't exist. Tino DeAngelis had perpetrated a massive fraud, filling the tanks mostly with water, with only a thin layer of oil floating on top for inspectors to see. When the fraud was uncovered, Allied Crude went bankrupt, and American Express was on the hook for $60 million in losses, a staggering sum that threatened to wipe out a significant portion of the company's net worth. Wall Street panicked. The story was sensational, sticky, and terrifying. The stock plummeted by more than 50%. The consensus was that the scandal might bankrupt the mighty American Express. The herd was stampeding for the exits. Warren Buffett, then a young, relatively unknown money manager in Omaha, saw the panic and became intensely interested. But he didn't look at the stock chart, and he didn't listen to the talking heads on Wall Street. He did what he always does. He went to work to figure out what the underlying business was actually worth. He became a detective. He engaged in what he called scuttlebutt. He went to banks, he went to travel agencies, he went to restaurants and hotels in his hometown. He talked to people, and he observed. He asked them, "Are you still accepting American Express travelers' checks? Are your customers still using the American Express card?" The answer, universally, was yes. He discovered that the scandal, as horrifying and embarrassing as it was, had not damaged the company's core business model in the slightest. The public's trust was in the traveler's checks and the cards, a completely separate entity from the disgraced warehousing division. The brand, the true source of the company's value, was intact. With this real-world knowledge, he then did the math. He calculated the earnings power of the core businesses, the traveler's checks, and the charge cards. He saw a phenomenally profitable enterprise that was gushing cash. He estimated that the company was earning around $10 per share. After the stock had crashed, it was trading for around $35. He knew the $60 million salad oil loss was a one-time event. It was a terrible flesh wound, but it was not fatal. The underlying business was a money-printing machine worth far, far more than $35 a share. In his conservative estimation, the business was worth at least $65 a share, and probably more. The market was offering him $1 of value for about 50 cents. So he acted, and he acted with breathtaking conviction. He invested 40% of his entire partnership's capital into American Express stock. It was the single largest investment he had ever made. He bet the farm. And, as the panic subsided and the company's immense earning power continued to assert itself, the stock price recovered and then soared. The investment was a grand slam, cementing his reputation and generating enormous returns for his partners. He didn't use a complex algorithm. He used shoe leather research and a common-sense approach to business valuation. The psychological principle at play here is a powerful one known as the salience bias, often working in tandem with the availability heuristic. Our brains are not rational calculating machines. They are story processors, and they give disproportionate weight to information that is vivid, recent, and emotionally resonant. The Great Salad Oil Scandal was the perfect storm of salience. It was a dramatic story involving fraud, Wall Street blue bloods, and vats of fake oil. It was easy to recall, easy to imagine, and it provoked a strong emotional response: fear. This vivid, available narrative completely overshadowed the boring, mundane, but far more important reality of American Express's durable franchise. The daily profitable transactions of millions of satisfied customers were invisible and abstract. The scandal was concrete and terrifying. The market, being a collection of human brains, massively overreacted to the salient negative news and completely ignored the underlying positive fundamentals. Buffett's advantage was his ability to invert this. He deliberately ignored the loud, dramatic story and focused his analytical energy on the quiet, powerful truth of the business. He understood that the stock market is a machine for translating short-term headlines into long-term opportunities for those who can resist the pull of the salient narrative. So how do we build our own blueprint for this, a model for calculating intrinsic value that doesn't require a PhD in finance? We can create what I call discounted cash flow for the rest of us. The principle behind a discounted cash flow, or DCF analysis, is simple. A business is worth the sum of all the cash it can generate for its owners from now until Judgment Day, discounted back to what that cash is worth in today's dollars. That sounds complicated, but we can simplify it into a four-step conservative process. Step 1 is to find the company's owner earnings. This is a Buffett concept. A simple proxy for it is the company's free cash flow, which is the cash left over after a company pays for its operating expenses and capital expenditures. You can find this number on most financial websites. Let's say a company you're looking at consistently generates about $1 billion in free cash flow per year. Step 2 is to project those earnings into the future, but to do so with extreme conservatism. Don't assume heroic growth. If the company has been growing at 10% a year, don't project that. Maybe project it will grow at 4 or 5% for the next 10 years, and then assume it stops growing altogether. The key is to be pessimistic. As Buffett's partner Charlie Munger says, invert, always invert. Think about what could go wrong and build that into your assumptions. You want to create a forecast that the company is highly likely to beat. Step 3 is to choose a discount rate. This is simply the rate of return you demand on your investment. A simple and effective way to think about this is to take the yield on the 10-year U.S. Treasury bond, which is considered a risk-free return, and add a few percentage points to it for the additional risk of owning a stock. If the 10-year bond yields 4%, you might demand a 9 or 10% return from your stock investment. That 10% becomes your discount rate. Step 4 is the calculation itself. You don't need to do this by hand. There are dozens of simple free intrinsic value calculators online. You plug in your conservative free cash flow number, your conservative growth rate, and your discount rate, and it will spit out an estimate of the company's intrinsic value per share. The goal here is not to find a precise number. As Buffett says, it's better to be approximately right than precisely wrong. Your goal is to get a ballpark estimate of value. Is this company worth around $50 a share or $150? Once you have that conservative ballpark estimate, let's say it's $100 per share, you now have your anchor of value. You can completely ignore the noise of the market and simply wait. You wait for the market to have one of its periodic panic attacks and offer you that $100 business for $60 or $50, or, if you're lucky, even less. This process transforms you from a passive price taker into a proactive value hunter. It provides the essential analytical foundation for any serious approach to financial education and stock picking. The antithesis to this disciplined approach is the deeply flawed and incredibly common method of relative valuation. This is the path of the 99%. Instead of calculating a business's absolute intrinsic value, they justify a purchase by comparing its price to other similar things. They'll say, well, stock X is trading at a price-to-earnings ratio of 20, while its main competitor stock Y is trading at a PE of 30, so stock X must be cheap. Or they'll say the average company in this sector trades at 3 times sales, and this one is only trading at 2.5 times sales, so it's a bargain. This is intellectual quicksand. As Buffett has noted, this is like trying to guess a man's weight by looking at his brothers. If he has 3 400-pound brothers, you might conclude that he, at 350 pounds, is the skinny one. Relative valuation tells you nothing about absolute value. During the dot-com bubble, justifying the purchase of one profitless internet company because it was cheaper than another profitless internet company was a path to guaranteed destruction. They were all standing on a mountain of absurd valuations and congratulating each other on being slightly lower down the slope. The only defense against this kind of collective insanity is to be anchored to your own, independently derived calculation of intrinsic value. Without that anchor, you are just another piece of driftwood in the emotional tide of the market, destined to be smashed against the rocks. The direct financial connection here is the very engine of superior returns. By establishing a firm, conservative estimate of intrinsic value, you create a bright, uncrossable line in the sand for your purchasing decisions. This is the ultimate tool for removing emotion from the act of investing. You are no longer swayed by fear or greed. You have a number. If the stock price is above your calculated value, you do nothing. If it falls below your value, by a predetermined margin of safety, you buy. It's that simple. This discipline provides a stunning financial advantage in 2 ways. First, it ensures you only deploy your precious capital when the odds of success are overwhelmingly stacked in your favor. You are only swinging at the fat pitches, the easy-to-hit home runs. This drastically reduces the probability of making a catastrophic error. Second, the journey of a stock's price from your deeply discounted purchase point back to its full intrinsic value is where massive market-beating capital gains are born. That 50-cent dollar you bought doesn't just protect you. Its return to parity is the very source of your outsized portfolio growth. By mastering the art of conservative valuation, you are not just picking stocks. You are engineering your own financial success with a rigor and discipline that the vast majority of market participants can never hope to match. Having a rational estimate of a company's value is a necessary condition for success, but it is not sufficient. You can know exactly what a business is worth, but if you lack the psychological fortitude to act on that knowledge, or, just as importantly, to not act when no opportunity is present, then the knowledge is useless. This brings us to our third pillar, the weaponization of temperament. The greatest single edge an individual investor has over the massive computer-driven institutions of Wall Street is not analytical, it is behavioral. It is the ability to be patient, to sit on your hands for months or even years, and then to act with decisive force when the perfect opportunity finally presents itself. The investing world is geared for action, for constant trading, for the relentless hum of activity. Buffett's great secret is that his immense fortune was built on long periods of intense boredom, punctuated by moments of extreme, focused activity. And no story better illustrates this superpower of patience than his multi-decade courtship of one of the world's most iconic brands, Coca-Cola. Warren Buffett did not discover Coca-Cola in 1988, the year he made his colossal $1 billion investment in the company. His relationship with the brand began as a child in the 1930s. He was a customer, buying Cokes for a nickel and selling them for a dime. As a young businessman, he saw its power firsthand. He owned shares in a vending machine company and saw the sheer volume of coins that poured out of the Coke machines. For over 50 years he watched the company. He studied it, he drank its products, he read its annual reports. He understood its business model at a granular level, a simple, easy-to-understand product with a global distribution network and a brand that was seared into the consciousness of billions of people. It was, in his mind, the perfect business, a forever company. He knew its value was immense and consistently growing. But for most of those 50 years, he never bought a single share. Why? Because the price was never right. The market, for the most part, recognized Coke's quality and priced it accordingly, often at a premium. There was no margin of safety. So he waited. He patiently sat, holding cash, for decades. Other investors were chasing fads, jumping in and out of hot stocks, but Buffett was simply watching his target, waiting for the market to make a mistake. That mistake arrived on October 19, 1987, a day that came to be known as Black Monday. In a single trading session, the Dow Jones Industrial Average plunged by nearly 23%, the largest one-day percentage drop in its history. The crash was driven by computerized trading programs, portfolio insurance schemes, and sheer, unadulterated panic. In the ensuing chaos and pessimism, the stock of Coca-Cola, despite having nothing fundamentally wrong with its business, was dragged down with everything else. The market, in a fit of terror, was suddenly offering shares in one of the world's greatest businesses at a price that Buffett found deeply attractive. He finally had his margin of safety. Over the next several months, he deployed over $1 billion, acquiring a massive 7% stake in the company. He didn't waver. He didn't try to time the absolute bottom. He simply saw that the price had finally fallen to a level that represented a significant discount to the immense and durable value of the business. That investment in Coca-Cola became one of his most successful ever, a core holding of Berkshire Hathaway that has generated tens of billions of dollars in capital gains and dividends. But the genius of the investment was not in the few months of buying in 1988. It was in the 50 years of patient, disciplined waiting that preceded it. The psychological forces that Buffett had to overcome during those 50 years of waiting are immensely powerful and trip up almost every investor. The first is called hyperbolic discounting. This is a fancy term for a simple human reality. Our brains are wired to crave immediate gratification. We would rather have a small reward now than a much larger reward in the future. It's why people choose to eat a donut now, rather than have a healthier body in a year. In investing, this manifests as an obsession with short-term performance. Investors can't stand the idea of holding cash while the market is going up. It feels like they are losing. They would rather buy a mediocre company at a fair price today than wait an unknown amount of time to buy a great company at a wonderful price tomorrow. The second and related bias is action bias. Our brains have a deep-seated need to feel in control, and taking action, any action, gives us the illusion of control. When markets are volatile or just plain boring, the urge to do something is immense. To just sit there, day after day, week after week, doing nothing, feels like negligence. So people trade, they tinker, they reallocate, they churn their own portfolios into oblivion, mistaking activity for progress. Buffett's temperament is the ultimate antidote to these biases. He is a master of what Charlie Munger calls assiduity, the ability to just sit on your ass and do nothing. He is perfectly happy to accept the small immediate pain of underperforming in a bull market in exchange for the massive long-term reward of having a mountain of cash ready when the inevitable crash occurs. To cultivate this superpower of patience, we can adopt a powerful mental model Buffett himself has championed, the 20-slot punch card rule. Imagine that at the beginning of your investing life, you are handed a punch card with only 20 slots in it. Each time you make an investment, you have to punch a hole. Once you've punched all 20 holes, you can't make any more investments for the rest of your life. This simple visualization immediately and radically changes your decision-making process. You are no longer looking for something to do this week or this month. You are forced to search for the truly extraordinary opportunities, the absolute no-brainer ideas that are worthy of one of your precious few punches. The blueprint for applying this is a 4-step process. Step 1. Create your watch list. This is a short list of 10 to 15 wonderful businesses that you can understand and that you believe have durable competitive advantages. Step 2. Value them. Using the DCF for the rest of us model, calculate a conservative intrinsic value for each company on your list. Step 3. Set your price. For each company, determine the price at which you would be willing to buy it, a price that offers you a substantial margin of safety. This is the price at which you would be willing to use one of your 20 punches. Step 4, and this is the most important step, do absolutely nothing until the market serves one of them up to you at your price. This might take months, it might take years. In the meantime, you read, you learn, and you let your cash pile up. This punch card mentality is the ultimate stock market strategy for forcing patience and discipline, ensuring that every investment you make is the result of deep conviction, not fleeting impulse. The antithesis of the patient punch card investor is the fear of missing out trader, the FOMO trader, who represents the 99%. This individual's emotional landscape is dominated by two forces: greed when the market is rising and fear when it is falling. They don't have a watch list of well-understood businesses. They have a news feed of hot stock tips. They are constantly scanning the horizon for the next big thing, the stock that everyone is talking about, the one that is going to the moon. Their primary motivation is not the fear of losing money, but the terror of being left behind while their friends and neighbors get rich. This leads to a disastrous pattern of behavior. They buy high, piling into a stock after it has already had a massive run-up, because the rising price provides social proof that it's a winner. Then, when the inevitable correction or crash occurs, their fear takes over. Lacking any fundamental conviction in the business itself, they sell low to cut their losses, often at the point of maximum pessimism. They then watch in agony as the stock recovers and vow to catch the next one earlier. This cycle of chasing performance, buying high on greed and selling low on fear, is a guaranteed recipe for wealth destruction. They are engaging in contrarian investing in reverse, and their portfolio is a graveyard of bad decisions, all driven by an inability to patiently wait for true opportunity. The direct financial connection of this weaponized patience is the transformation of cash from a liability into your most powerful strategic asset. For the typical fund manager or FOMO trader, cash is a drag on performance. They are judged on quarterly returns, and cash earning next to nothing looks terrible when the market is roaring. They feel immense pressure to be fully invested at all times. For the disciplined value investor, cash is the polar opposite. Cash held in a portfolio is not a dead asset. It is a call option with no expiration date and no strike price. It is potential energy, waiting to be converted into the kinetic energy of purchasing power at the moment of maximum opportunity. Holding a significant cash position during the euphoric peak of a bull market is what allows you to go shopping during the despair of an economic recession or a stock market crash. When the prices of premier assets are being slashed by 30, 40, or 50%, your cash becomes exponentially more powerful. The patient investor who held cash in 1999 was able to buy the entire landscape of American business for pennies on the dollar in 2002. The investor who was flush with cash in 2007 became a king in 2009. Patience is the mechanism that allows you to harvest the fruits of other people's impatience. It is the bridge that carries you from the dangerous peaks of market euphoria to the fertile valleys of market despair, where the seeds of financial freedom are sown. Once you have mastered the distinction between price and value, learned how to calculate a conservative estimate of that value, and cultivated the supreme patience to wait for a bargain price, you need one final piece to complete the core framework. You must learn how to view the market itself, not as a source of wisdom or guidance, but as an emotional, unpredictable, and ultimately exploitable business partner. This brings us to our fourth pillar: internalizing the parable of Mr. Market, the most powerful investing analogy ever conceived. This mental model, created by Buffett's mentor Benjamin Graham, personifies the stock market, transforming it from an intimidating, amorphous force into a simple, manageable character. Learning to properly manage your relationship with Mr. Market is the key to turning widespread fear into personal fortune. The parable is simple. Imagine you are a private owner of a wonderful business, and you have a business partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your office and offers you a price. He tells you what he is willing to pay for your share of the business, and he also tells you the price at which he is willing to sell you his share. The key thing to understand about Mr. Market is that he is a manic depressive. Some days he arrives in a state of wild, uncontrollable euphoria. On these days, buoyed by good news and optimism, he offers you ridiculously high prices for your stake. He is so giddy that he is willing to pay far more than the business is rationally worth. On other days, he shows up in the depths of a black, crippling depression. Overwhelmed by bad news and pessimism, he is convinced the business is doomed. On these days, he offers to sell you his stake for pennies on the dollar, at prices far, far below the business's true value. The beauty of this partnership is that Mr. Market does not care if you ignore him. He is your servant, not your master. You are free to take advantage of his offers, or to completely disregard them and go about your day. You don't have to trade with him just because he shows up with a quote. You only have to engage when his mood swings to an extreme that benefits you. Warren Buffett has lived his entire career by this parable. He sees the daily fluctuations of the stock market as nothing more than the manic depressive ramblings of his partner, Mr. Market. When the market soars to new highs and valuations become stretched, he sees Mr. Market in his euphoric phase. He doesn't get swept up in the excitement. He calmly notes the high prices and may even consider selling a few things to his overenthusiastic partner. But it is during a market crash that the parable becomes most powerful. The 2008 global financial crisis was perhaps the greatest bout of depressive psychosis Mr. Market has ever suffered. The entire global financial system was on the brink of collapse. Fear was not just palpable, it was the only emotion left. Lehman Brothers had failed, AIG was bailed out, and the entire banking sector seemed moments from insolvency. Mr. Market was not just pessimistic, he was suicidal. And in the midst of this terror, Warren Buffett did not panic. He did not hide. He saw his partner, Mr. Market, standing on a ledge, ready to sell his most prized possessions for virtually nothing. So Buffett acted. He wrote a now-famous op-ed in the New York Times in October 2008, titled, "Buy American I Am." It was a public declaration of his philosophy. While everyone else was consumed by fear, he was methodically deploying billions of dollars. He made preferential deals with giants like Goldman Sachs and General Electric, injecting capital when no one else would, and securing incredibly favorable terms. He was buying premier American businesses from his terrified partner at prices that reflected not their long-term value, but the short-term panic of the moment. He was not trying to predict when the fear would end. He was simply acting on a timeless principle: be fearful when others are greedy, and be greedy only when others are fearful. He was exploiting Mr. Market's depression on a scale that the world had never seen. Those investments, made in the darkest hours of the crisis, were fantastically profitable, generating billions upon billions for Berkshire Hathaway shareholders. He did not have a crystal ball. He had a sound mental model for understanding the market's emotional nature and the temperamental fortitude to act as a provider of liquidity when the world was desperate for it, and as a provider of sanity when the world had gone mad. The psychological demons that Mr. Market preys upon are the affect heuristic and myopic loss aversion. The affect heuristic is our brain's shortcut of letting our gut feelings and emotions, our affect, drive our decisions. During a crash, our emotional state is one of fear and anxiety. Therefore, when we look at a stock, our brain subconsciously labels it risky and bad, regardless of its underlying fundamentals. We feel the fear, and we project that feeling onto the investment itself. The rational part of our brain is completely bypassed. This is compounded by myopic loss aversion. Behavioral scientists have shown that the pain we feel from a loss is psychologically about twice as powerful as the pleasure we feel from an equivalent gain. Furthermore, the more frequently we check our portfolio, the more we feel this pain. During a crash, when investors are glued to their screens watching their net worth decline, they experience a cascade of small, painful losses. This myopic focus on the short-term pain becomes unbearable, leading them to make the catastrophic decision to sell at the bottom, just to make the pain stop. Buffett's Mr. Market framework is a direct counter-assault on these biases. By personifying the market as an emotional wreck, he creates psychological distance. He is no longer a participant in the market's emotions. He is an observer and an analyst of them. This allows him to engage his rational brain while everyone else is running on pure, unadulterated fear. The applied mental model for us to internalize this is the Mr. Market visualization technique, a simple daily practice. Step 1. Actively personify the market. Give him a name if you want. Picture him. Maybe he's a nervous, twitchy character in a rumpled suit. The more real he is in your mind, the more effective the technique. Step 2. Every morning, as part of your routine, imagine Mr. Market knocking on your door. He holds up a list of all your stocks and gives you his bid and asks prices for the day. Remind yourself that these prices are not based on rational analysis but purely on his mood. Is he giddy today? Is he terrified? Step 3, and this is the crucial part. After looking at his prices, you consciously make a decision. You can say, "No thank you, Mr. Market, your prices are silly today. I'm not interested. Come back tomorrow." Or you can say, "You seem awfully depressed today, Mr. Market. That price you're offering for this wonderful business is absurdly low. I'll gladly take some off your hands." The key is to reframe the interaction. You are in control. You are the boss. The market is just an emotional guy making you offers. This simple daily visualization breaks the market's hypnotic spell. It stops you from seeing the market as an all-knowing oracle and starts you seeing it for what it is, a source of opportunity, not a source of instruction. This is the core mental shift required for beating the market. The antithesis, the path of the 99%, is to treat the market not as a servant, but as a guru. They see the market as an omniscient, all-powerful force that is smarter than they are. If the market is going up, they take it as confirmation that their investment decisions were correct. The rising prices provide a warm, comforting validation. If the market is going down, especially during a stock market crash, they take it as a judgment. The market is telling them they were wrong, that their companies are in trouble. They have outsourced their critical thinking to the collective mood of the crowd. They become a puppet, and Mr. Market pulls the strings. When he is euphoric, they feel euphoric and buy. When he is depressed, they feel depressed and sell. They are perfectly in sync with his madness, and their portfolio suffers the consequences. They have abdicated their responsibility to think for themselves, and in the world of investing, that is the single most expensive mistake you can ever make. The direct financial connection of this mental model is the transformation of volatility from a measure of risk into a measure of opportunity. For the academic and the average investor, stock price volatility is synonymous with risk. A highly volatile stock is considered a risky stock. But for the true value investor, this is nonsense. As Buffett says, volatility is far from synonymous with risk. The true risk is the permanent loss of capital. Volatility, the wild up and down swings in price driven by Mr. Market's moods, is the very thing that creates the margin of safety. The more manic-depressive Mr. Market becomes, the more volatile the market is, the more frequently he will offer you wonderful businesses at foolish prices. High volatility is a value investor's best friend. By learning to love volatility, you can systematically use the market's irrationality to enhance your portfolio growth. When the market panics and sells off indiscriminately, you are there, calmly buying the dip, not as a hopeful guess, but as a calculated, strategic action based on the gap between your partner's emotional price and your own rational calculation of value. You are, quite literally, arbitraging human emotion, and it is one of the most reliable sources of excess capital gains available to the intelligent investor. We have now assembled the core components of the margin of safety philosophy. We understand the chasm between price and value. We have a framework for calculating that value. We have cultivated the temperament to wait for the price to fall far below that value. And we have learned to view the market as an emotional servant who provides us with these opportunities. This brings us to our fifth and final pillar, the grand synthesis, building an unbreakable portfolio by combining the margin of safety with another of Buffett's core concepts, the economic moat. The ultimate margin of safety is not just buying a statistically cheap business, it is buying a truly wonderful business at a fair or even cheap price. This is the fusion of quality and price, the final piece of the puzzle that creates a true, unstoppable, long-term compounding machine. For the first part of his career, Buffett was a cigar-butt investor, a pure disciple of Ben Graham. He would look for companies that were statistically, absurdly cheap, even if the businesses themselves were terrible. He described them as cigar butts found on the street. They might have one good puff left in them, and if you could get it for free, it was a profitable endeavor. He made money this way, but it was difficult, gritty work, and it wasn't scalable. His thinking was forever changed by his partner, Charlie Munger, who convinced him that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This led to the focus on the, quote, economic moat, a durable competitive advantage that protects a business from competitors, much like a moat protects a castle. A moat allows a company to earn high returns on its capital for very long periods of time. The greatest, most resilient investments, the ones that build true generational wealth, are those that combine a wide economic moat with a wide margin of safety. And perhaps no investment in Buffett's later career demonstrates this synthesis better than his massive and initially controversial bet on Apple. For decades, Warren Buffett famously avoided technology stocks. He often said he didn't invest in them because he didn't understand them. They were outside his, quote, circle of competence. So the world was stunned when, starting in 2016, Berkshire Hathaway began buying Apple stock. And they didn't just nibble, they bought it by the tens of billions of dollars, making it by far their largest single holding. By the time they were done, Berkshire owned over 5% of the entire company. Many critics said Buffett had lost his touch, that he was abandoning his principles and chasing a hot tech stock. But they had misunderstood his analysis completely. Buffett didn't see Apple as a technology company. He saw it as a consumer products company with one of the greatest economic moats of all time. The moat was not the hardware, the iPhone itself. The moat was the ecosystem. It was the powerful lock-in of the App Store, iCloud, Apple Music, and the seamless integration between all the devices. It was the incredible brand loyalty, the almost cult-like devotion of its customers, which gave it enormous pricing power. He saw a business that was not a fleeting tech fad, but an indispensable part of hundreds of millions of people's lives. He had identified the wide moat. Next, he needed the margin of safety. At the time he was buying, Apple stock was not in the bargain basement. It had already had a phenomenal run, but it was unloved by Wall Street. The narrative was that the iPhone's growth was over, that it was too big to grow, and that it was facing intense competition. The stock was trading at a very low multiple of its earnings, far lower than other, lower-quality consumer brands. Buffett, doing his value calculation, saw a company gushing unbelievable amounts of free cash flow, buying back its own stock aggressively, and with a long runway of growth in its services division. He concluded that Mr. Market, in his obsession with quarter-to-quarter iPhone sales, was dramatically undervaluing the long-term power of the Apple ecosystem. The price, while not dirt cheap, was still significantly below his conservative estimate of its intrinsic value. He had found his combination, a castle with an unbreachable moat and a market that was offering him the keys for a very reasonable price. The investment has been an astronomical success, generating over $100 billion in gains for Berkshire. It is the ultimate case study in the power of combining the search for high-quality businesses with the disciplined demand for a margin of safety. The psychological biases that this final pillar helps us overcome are the narrative fallacy and its evil twin, confirmation bias. The narrative fallacy, a term coined by Nassim Nicholas Taleb, is our tendency to be seduced by compelling stories, to create simple, coherent narratives out of complex, random facts. In investing, we fall in love with the story. This company is the future of artificial intelligence, or this biotech firm is on the verge of curing cancer, and this story clouds our judgment. We then fall prey to confirmation bias, which is the tendency to seek out and interpret information that confirms our pre-existing beliefs, and to ignore information that contradicts them. If we believe a company is the future, we will only read the positive articles and listen to the bullish analysts. Buffett's two-part filter, moat first, then margin, is the perfect antidote. The moat analysis is a harsh, unsentimental test of business reality that cuts through the narrative. Does the company truly have a defensible advantage, or is it just a good story? Only after a business passes this rigorous quality test does he even begin to consider the price. This two-step process prevents him from falling in love with a story and forces him to remain a cold, hard-nosed business analyst. The applied mental model to put this all together is the moat and margin checklist, a final 5-step blueprint for making world-class investment decisions. Step 1. Moat identification. Before you do any financial analysis, you must be able to simply and clearly articulate the company's economic moat. Is it a powerful brand like Coca-Cola? Is it a network effect like Facebook or Visa? Is it a low-cost production advantage like Geico? Is it high switching costs for its customers, like with Microsoft? If you can't identify the moat in a single sentence, move on. Step 2. Moat durability. This is a qualitative judgment. Ask yourself, is it highly likely that this competitive advantage will still be intact and just as powerful in 10 or 20 years? Is it being widened or narrowed by technology and competition? You are looking for castles built of granite, not sand. Step 3. Intrinsic value calculation. Now you do the numbers. Using your conservative DCF model, calculate the intrinsic value of this durable business. Step 4. Margin of safety mandate. This is non-negotiable. Define your required discount to intrinsic value. Is it 30%, 40%, 50%? Write it down and do not compromise on it for any reason. Step 5. Execution and patience. Place the company on your watch list with your mandated buy price next to it. Then, wait. When Mr. Market finally offers you that price in a moment of panic or neglect, you act with conviction, knowing you have not just bought something cheap, but you have bought a piece of a truly great enterprise. This checklist is the culmination of our entire framework, a professional-grade system for asset allocation and executive decision-making. The antithesis to this synthesized approach manifests in two common failure modes. The first is the pure cigar-butt investor, who focuses only on the margin of safety and ignores the moat. They buy terrible, dying businesses just because they are statistically cheap. While you can sometimes find one last puff of profit, you are often buying into problems that are far worse than they appear on the balance sheet. You are buying a melting ice cube, and you have to be right about the price and the timing. It's a hard way to make a living. The second and far more common failure mode today is the growth at any price gambler. This investor does the opposite. They become obsessed with the quality of the business, the moat, and completely ignore the margin of safety. They fall in love with the story of a wonderful, innovative company and convince themselves that no price is too high to pay for quality. They bought the Nifty 50 in 1972. They bought Cisco Systems in 2000. They bought the high-flying, no-profit tech darlings of 2021. In each case, they were often right about the quality of the business. But because they paid a price that discounted not just the future but the hereafter, they suffered devastating losses. Paying too much for a wonderful company can be just as destructive as buying a terrible company at any price. The moat and margin checklist protects you from both of these fatal errors. And this brings us to the ultimate direct financial connection, the creation of a portfolio of true compounding machines. The magic of long-term wealth creation does not come from trading or speculation. It comes from owning wonderful businesses for very long periods of time and letting the miracle of compound interest do its work. A business with a wide and durable economic moat is a compounding machine. It can reinvest its profits back into its business at high rates of return, year after year, protected from the ravages of competition. When you, as an investor, are able to purchase a share in one of these compounding machines at a price that represents a significant margin of safety, you create a financial supernova. The margin of safety protects your initial capital from loss and provides the initial rocket fuel for your returns as the price reverts to fair value. The economic moat then takes over, compounding your capital at a high rate for years or even decades to come. This is the holy grail of investing. It is the engine of true financial freedom. It is how fortunes that last for generations are built. It is the final and most powerful expression of using the market's temporary panics to acquire permanent value. You've made it to the end. And if you have truly absorbed the lessons of these last 5 pillars, your perception of the financial world has been permanently altered. You no longer see a stock market crash as a threat. You see it as the single greatest wealth generation opportunity of your lifetime. A sea of red is no longer a signal of danger, but a sign that the greatest store on earth, the store of premier corporate assets, is having a fire sale. You have acquired the fundamental principle that separates the amateur from the master, the margin of safety. You now possess the mental toolkit to distinguish price from value, to calculate that value, to wait patiently for a discount, and to exploit the market's emotional instability as your primary source of profit. This is more than just a strategy. It is a complete philosophical shift. But the margin of safety, as powerful as it is only the first layer of the armor. It's the shield. It is the ultimate defense that protects you from catastrophic loss and ensures you survive the battle. What about the sword? What about the mental models Buffett uses to identify the truly exceptional businesses, the unstoppable compounding machines with the widest moats that are worth buying in the first place? Knowing when to buy is half the battle, and you have just mastered that. Knowing what to buy is the other, more crucial half. Because buying a mediocre business, even at a 50% discount, will only ever yield a mediocre result. But buying a truly magnificent business at even a 20% discount can change your family's financial future forever. The system is a network, and each piece strengthens the others. The margin of safety is intertwined with the concept of the economic moat, which is intertwined with the idea of the circle of competence. They are all part of a single, cohesive mental framework. The video on your screen right now isn't just another clip. It's the next link in that chain. It is the piece of the map that connects the concept of price to the concept of quality, forging them into a single, unbreakable weapon for wealth creation. It builds upon the foundation you've just laid and takes you to the next level of analytical mastery. You have already proven you are not part of the 99% who flee from knowledge or seek simple, useless answers. You invested your most valuable asset, your time, to get to this point. The question now is, are you a tourist in this world of elite thinking, or are you committed to building the full arsenal? Are you content with the shield, or do you intend to claim the sword as well? The choice is simple. The committed continue the ascent. Click and master the next piece.